If the solvency means after getting a loan or for finance support from any institution, they want to go for repay. So that is related to the commercial bank containing the core principle effective banking supervision. The ratio is known as the capital to risk asset ratio. Okay, CRAR. The non-performing assets are listed on the balance sheet of the bank and other financial institution. Hello everyone, a warm welcome to one and all. I am Natesh, lecturer in Commerce, Vidyashram First Grade College, Mysore, the Temple of Excellence. We are in the Unit 3, Session 2, second semester BCom Law and Practice of Banking. So the chapter name is Banking Regulation Act 1949. In the last session, which is related to Narasimha Committee 1, okay, and a few other things. Now today my agenda, Narasimha Committee Report 1998. So, and the prudential norms, under prudential norms, what and all is coming, and the capital adequacy norms, okay, or we call it as a capital adequacy ratio, and the non-performing asset, and the measure to reduce the NPV, which is a non-performing asset. Here, under any committee or frame, because of the government of India or the banking sector, if they want to get any progress or finding a development, so the committee or frame under the chairman of Narasimha, so the second report is submitted. In the first report, which is submitted in the year of 1991, the second report is submitted in the year of 1998. The few suggestion or recommendation is given to the government, okay, about the banking operation. So, in the year 1998, the government appointed yet another committee under the chairmanship of Narasimha. Okay, so it is better known as a banking sector committee, because the Narasimha committee, which is completely concentrating, which is the development of what kind of development, what kind of recommendation can be provided to the government of India. Okay, so here the committee focus on the various areas such as the capital adequacy, because the banking is maintaining a two kind of ratio. Okay, one is cash reserve ratio and statutory reserve ratio. The capital adequacy means what? So the sufficient balance should be there in the banking operation. The banking merger, because of recently we found there are too many banks are merged together. Okay, so the banking merger related and the banking legislation, etc. It submitted, it report to the government in the year of same 1998 April, okay, April, with the following recommendation. What in the second report, what recommendation Narasimha Committee is given, provided to the government. So the first one, strengthening a banking in India, because now we are standing in the global competition. So definitely we need to develop the banking system, because the banking system which is coming dealing the financial products or financial instrument. So how we can develop either rural bank or top large scale operation, okay, everything which is coming under the strengthening, how you can increase your strength using latest technology or core banking system, how you can expand your banking system operation. And now next to capital adequacy ratio, the capital adequacy ratio, what sufficient balance they want to maintain, what is an asset which is related to the capital, okay, and review of banking law, because of we know there are banking reform under, there are too many act which is related to banking operations. So again the act how it is performing, so exactly you need to review properly. And the narrow banking, because we are coming under broader is a different and narrow banking is a different. So we need to run in the very unique manner. And the banking ownership under private ownership and government ownership. We know the RBI, the total 5 crores authorized capital, the government is contributed only for 22 lakhs. The rest of the things which is accepted from the public. Now prudential norms, okay, the prudential norms, liquidity and solvency, which is because under regulation, which is not only for cooperative society, cooperative bank, as well as cooperative bank and commercial bank. So when they are performing, so what kind of liquidity position they want to maintain in their respected banking sector. And the solvency, if the solvency means after getting a loan or finance support from any institution, they want to go for repay. So that is related to the commercial bank containing the core principle effective banking supervision, because under the chairman of Narasimha, because they are trying to go for recommending the government of India, which is related to running. So the supervising, which is coming under the board, which is under the RBI, there is one specific autonomous body, as published by the Basel Committee of Banking Supervision in October 2006. And revised from the time to time, because the revised statement, the revised rules and regulations which is related to the banking operation, and the solvency and asset coverage norms of insurance company containing in the insurance core principles and methodology, because the banking is not only doing individual product, apart from the insurance product also they are trying to do. So they want to maintain the coverage, okay? So the coverage which is related to the capital adequacy or solvency capacity, okay, as adopted by the International Association of Insurance Supervision in the October 2003 and revised from time to time, because we cannot stick into one year, because of everything changes. We need to go for change. So we are finding a change in the methods, what and all, which is coming under the standard of insurance supervisions. In line with the international practice, what other country are adapted for operation of banking operation, so that we are bringing the standard for international, so that we can compete with the internationally. So, and as per the recommendation made by the committee on the financial system, under financial system, banking system, how it is operating, so there is something standard like which is a international standard. The chairman Sri Narasimha, the Reserve Bank of India has introduced, okay, so the chairman, the second report is given a lot of capital adequacy prudential norms, okay, and solvency. Now, capital adequacy norms, what exactly the capital adequacy norms, which is related to the government of India appointed the Narasimha committee in the year of 1991. They prepared first report. Okay, so they suggested a few suggestions for the government, reducing SLR, CRR. Suggest reform the financial sector, because financial sector is a booming sector. So we are finding we are able to compete with the global standard. Okay, in the year of 1992-93, the Narasimha committee submitted his first report and recommended that all the banks is required to have a minimum capital of 8%. Now it is maybe it is increasing, because we are competing with the international standard. So to risk weighted asset of the company, because here the performing asset or non-performing asset, what is the risk is bear by the individual assets, okay. The ratio is known as the capital to risk asset ratio, okay, CRAR, okay, capital to risk asset ratio. All the 27 public sector bank in India except UCO and Indian Bank, okay, so had achieved the capital adequacy norms of 8% in the March 1997, except UCO and Indian Bank. There are 27 banks are public sectors bank, so except two banks, all the banks are achieved for the, okay, the minimum. And here the capital adequacy norms we further classified into 4 types. One is tier 1, tier 2, and risk weighted asset and subordinate debts. Okay, so because equally we are trying to study for the each components, very important. And the non-performing asset, non-performing asset means what? The non-performing asset refers to the classification of loans and advance that the default in the arrear, because bankers are providing a different types of loans, okay, even the advance which is coming under the assets side, balance sheet, current assets and loans and advance when they are preparing the balance sheet. So the loans and advance, what they're lending, what they're accepting, so completely non-performing asset which is related. A loan is arrears when principal and interest payment at later are missed, because whenever the institution, financial institution lending a loan, the collection of interest, even the repayment they are accepting. A loan is a default when the lender considers the loan agreement to be broken, because whenever the loan is promptly, whenever they are trying to recover the money or repayment is promptly happening, so then the function is very easily running. Okay, the non-performing assets are listed on the balance sheet of the bank, and other financial institution, because what and all the assets which is related to the balance sheet, everything which is not performing, which is not generating. So that's what, after the prolonged period of non-payment, the lender will forced to borrow the liquidate asset what they were pledged for part of the debts agreement, because the banker financial institution blindly they cannot provide the loan facility taking some guarantee or surety, pledging a documents or pledging properties like a mortgage loan, you can say collateral security. Okay, after getting the loan, if the payment is not recover, okay, the loan amount is not recover, it is very difficult to operate the banking operation. And the factor contributions to NEP, what and all the what factors are contributing to non-performing asset. The first one, diverse of fund, which is completely the fund is whatever the accepting deposit from the depositor or customer. So when they are lending a loan amount is not recovering very fastly, so the diversification of fund is only for going for the lending loan. Okay, and the business failure are internal factor, because the business when their banking sectors are providing a finance support for the businessman, if the business are not succeed or failed, of course the banking sectors are facing a lot of problems. The business value external factor, so which is completely based on the internal factor, what and all which is connected for the business operation, and even the external factor, there are too many factors are connected for the business. Why the business is failing? There are too many products will be failing because of there is no acceptance, because of awareness, there are different. The bank being responsible for non-performing asset, non-performing, because of the bankers are provided finance support to the businessman. So whenever they are providing a loan facility, of course they try to take a collateral or mortgage loan, mortgage properties. The measures to reduce NPA, because non-performing is the first one, debt recover tribunal. Debt is nothing but long-term loan. Okay, because the businessman, there are different types of loan are provided for long period, so you need to take a proper measurement. Okay, and loc adult, because of a committee, there are different they are approaching in the different manner. And next, compromise settlement, how we are trying to go for settlement. There is a specific team like a recovery team, they try to go for collecting the loan amount. And the credit information bureau, where the credit information at the end of the month or at the end of the year, they are trying to maintain the database based on the database which is completely credit information bureau, which is dealing with the credit sanctioned by the individual banking system. Suppress Act in the year of 2002, which is also the major source collection of the act which is related. Keep on watch for next section. Thank you.